Most of us normal people just can't out-invest index funds. Plain and simple as that. And the solution for that is to maybe just accept 8 to 10% long-term, 30-year returns by investing in a total broad stock market. Okay, that is my solution, and maybe it might be the right solution for you. And now I'm going to give you some really good reasons on why you probably can't out-invest index funds. Make sure you stay to the end because, believe it or not, you might end up in jail trying to out-invest index funds. More on that later. Let's start out with the reason number one. And the reason number one on why you can't out-invest index funds is that most active professional managers can't do it themselves. Most professional mutual fund managers, they cannot out-invest index funds. It's pretty crazy. So if the professionals can't do it, then maybe you and I can't do it as well. Maybe. And to back this claim up, a 2021 report from SPIVA, and SPIVA is the Standard & Poor's Index versus Active, they claim that 86% of domestic funds can't out-invest their S&P 500 fund over 20 years. So 86%, and those are professional managers. We're talking about these professionals that do this for a living. They're managing mutual funds, trying to out-invest their benchmark, which is usually the S&P 500. And if they can't outperform their benchmark, which is just the passive index, just the self-cleansing index, then what makes you think that you and I can? Maybe you are part of that 14% of people who can do it over a 20-year period. But more likely than not, you're not. I don't think that I can do it, and maybe you can't do it as well. And similarly to that, last year in 2020, SPIVA's report actually reported that 92% can't even beat the S&P 500 over a 20-year period. So hopefully you can see that on the screen. But these are really high percentages that cannot outperform the S&P 500 or the general total U.S. stock market. And if most of these people can't outperform the stock market, I don't think that I can, and maybe you can't either. And that's just the beginning. Let's go on to number two. And number two is that trying to beat the stock market, trying to beat the general stock market, it's so time consuming, especially if you're trying to do it right. If you're not just picking random things and hoping for the best, then you're probably going to be spending a lot of time trying to outperform the index. Okay, and that can be really time consuming. That could become another part-time job. Who really has all the time to do all that? You expect your professional financial managers, like managing a mutual fund, you expect them to always stay current on current financial news. You expect them to read shareholder reports. You expect them to analyze financial statements, like all these big company financial statements. And they're supposed to be doing that for many different companies, depending on how many there are going to be putting into their mutual fund. If you expect them to do that, then you're probably going to have to be expected to do that yourself if you're trying to out-invest the index fund. And so who's going to have time to do all that? Have you ever actually looked at a shareholder report? Have you ever actually looked at a financial statement and read it and understand it, from the beginning to the end? It's a lot of pages. I had to do it myself in college, and trust me, it is not fun analyzing those financial statements. And it's also going to take you a lot of time. If I only did that with one company, like a full analysis, imagine having to do that all the time for multiple different companies that you're trying to invest in. It's really time consuming, and maybe even the amount of time that you spend on it, even if you were to get a little bit better, maybe you could have better spent your time somewhere else, especially if you're trying to become financially independent, because if you should already know by now that your time is the most precious thing that you have, and so you want to spend it doing things that you want to do. And if you don't want to analyze financial statements, look at shareholder reports all the time, trying to out-invest the index fund, then perhaps maybe you should consider just index fund investing. And that leads me a little bit into number three. Even though it is time consuming trying to out-invest the index fund, it's also very tax inefficient. Especially if you're trying to invest with that kind of like a day trader mindset where you're just, analyzing the stock market and you're just trying to, time the market and things like that. You're going to probably be doing it while you're probably going to be buying and selling within under a year time frame. And that means that any kind of gains that you do make, they're only going to be short-term gains. And of course, your losses, as we all know, are going to be limited. You can't take unlimited losses. So if you lose a ton of money, you're going to have to keep rolling those over year to year for investment losses. You can't just take $20,000 of losses in 1 year. It doesn't work that way. The IRS is not that friendly. But you can definitely take $20,000 worth of gains every year and then pay taxes on that. that's a whole nother story. But if you are doing like a short-term trading and you're trying to time the market rather than, investing into the total stock market and holding for the pretty much a long time, for the unlimited amount of time, then you're probably going to be realizing short-term capital gains. And that means that you're going to be taxed at your individual tax rate rather than at the tax advantaged long-term capital gains tax rate. And that means that more of your returns, even if you are able to manage to make some returns, are going to be taxed, and it's going to eat away at your total return because you're paying short-term capital gains. Now, not only is trying to out-invest the index fund hard, like difficult, when it comes to your time and when it comes to the amount of effort and when it comes to taxes, but also there are some psychological things that make it a lot more difficult. Before I move on to that, please make sure that you like this video. If you are liking the video so far, it really does help me out and I really do appreciate that. Also, just by hitting that like button, just by hitting that like button, you are helping to spread this message to people that really need to hear it. Thank you so much. But moving on to number 4, very psychologically, a very psychological reason why it's really hard to out-invest index funds is that we have biases. We as human beings, we are biased. We have all kinds of different biases. Maybe you learned that in Psychology 101 or whatever class in college. But we have biases. And here's one that is, very prominent when it comes to investing, and that is trend biased. So we're going to be biased towards things that are trending, things that are popular in the time. So here are some examples of that. You have meme stocks, you have cryptocurrency, and in 2008 we had real estate. So those things were all, really popular at the time. Right now, cryptocurrency is really popular. In 2008, around that time frame, real estate was really popular, and so everyone was getting on that bandwagon, and that is trend bias. We are biased towards things that are trending. We are biased towards things that are happening right now. That could be really detrimental for your long-term investment portfolio. So you want to try to avoid trend bias, and just by investing in the market, that really essentially does avoid trend bias. But that's not the only bias that we have. There is also a bias known as confirmation bias. And confirmation bias just basically means we are seeking information that is already supporting what we think. So when you are investing in, like when you're just trying to decide what to invest in, let's say you're like, I'm going to invest in stock number A. When you're actually doing your research, more than likely, you're going to seek things that are going to support your reasoning for wanting to buy that particular stock. So you're going to find stuff that says, hey, this stock is going to go up in value, or this they just bought all this equipment and that's going to make their profits go up by X amount of percent. You're going to probably find things that are going to support your original idea for buying that stock, rather than find information that is going to conflict with reasons why you shouldn't buy that stock. So confirmation bias is something that you really do need to look out for if you're trying to invest, other than just buying the general, broad stock market. And lastly, I have another really good bias one for you, and that is known as hindsight bias. So how many times have you heard someone say, I knew that stock was going to go up, or I knew this industry was going to go up like crazy, but they didn't actually act on it. Yeah, now that it's actually happened, it's easy to look back at it, after the fact. It's easy to look back and say, oh, I kind of did know that. But your mind can play tricks on you. You probably didn't know that. Because if you did know that, or if you did really strongly think that was going to happen, you would have invested in it. You would have put a lot of money into it. But you didn't know until after it already happened. And that is known as hindsight bias. It's no good to know the answer after something has already happened. It's no good to know the lottery numbers after it's already happened, right? You need to know it before it, and you need to actually buy the ticket. You need to look out for hindsight bias. You need to look out for all those biases. And index fund investing, it can help us avoid all these biases all at one time. But that's not all that index fund investing can help us avoid. As I mentioned in the beginning, number 5 here is you can avoid getting sent to jail. And this is a little bit more of an extreme example, but I really wanted to talk about this because it's pretty crazy. So insider trading is illegal. If you have information that the public pretty much doesn't have about a certain company, about what a company is going to do, then that is known as insider trading. You have information and you're trading based on that information that is not available to the public, and that is very, very illegal. You might think that this couldn't happen to you, but do you have a friend that works for a publicly traded company? Do you know someone, maybe a family member, that is a high-level executive in a company? If you do, then they could possibly, not even knowingly, pass on insider information to you. And if you trade based on that information, that is technically insider trading. That's technically illegal. You should definitely not try to get insider information, because if you get caught, it could be, a really big fine. It could be, you could end up in jail. I do know someone that works for a Fortune 500 company, a company that is really high up there, and they may know, some crazy secrets going on within that company. And if they were to unknowingly pass that information on to me, and I knew that, hey, they're gonna, work on this certain project coming up, but the public doesn't know that, I could, buy their stock of that company, and that company could then, release that information, and then all of a sudden the stock goes up because that information is really beneficial to the company, and that would be insider trading on my part. So that is very illegal according to the SEC, and you don't want to get caught up in that. But what you do want to get caught up in is the video that I created. It's a full guide to achieving financial independence by investing. So watch my full guide to investing your way to financial independence. And thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.